Good afternoon, everyone. My name is Bill Fox with the Fox Alliance. Welcome to our third quarter economic outlook. Our goal is to offer insight into big economic themes. Our topic for today is the Chinese Communistic Crackdown. We will be discussing the effects of regulations on tutoring and private schools. How is the tech crackdown going to affect Alibaba and TikTok? What's happening to Evergrande? We'll be talking about China's focus on redistribution of wealth, China's goals moving forward, and how might all of this affect global markets. Our panelists will be speaking for 30 minutes and leave 15 minutes for questions at the end. Based on regulatory and compliance rules, we can't take questions via the chat feature. If you do have questions that you'd like to ask our panel, please email me at the email address on the screen. Our presenters today will be Max Clark and Laura Cooper. Both are wealth advisors with the Fox Alliance. Our third presenter will be Josh Renfro. He's one of our managing partners. Max will be our first presenter. Max, take it away.
Thanks, Bill. I sure appreciate it. Again, we are grateful that you guys have chosen to spend a little bit of your afternoon today with us. We're looking at an exciting topic, which is what's happening over in China. It's amazing to see how quickly things are changing there. The landscape and the regulatory environment is changing rather quickly. It seems like every day we're getting new news out of China. But to kick things off, if you guys will read this very closely, this is the disclosure for our conversation today. I think we'll move on now. If we take a look at kind of to kick things off, the journey here, how do we get to this point and what has brought China to where they are today? And I think a good way to describe the past 40 years of Chinese history would be savage growth. If we look back at where they've come, the chart on the screen here shows the historical GDP growth that China has averaged over the last 40 years. And we've chosen this 40-year period because it's rather significant. If we look back to 1979, prior to that date, China had been operating effectively in a very communistic way, not a lot of foreign involvement. Everything was pretty locked down prior to that date. But in 1979, China made the decision to open to foreign trade and investment, and they really implemented a lot of free market reforms, which since then has caused China to experience significant growth. What's interesting is we call it savage growth because China really took an approach that was growth at all costs. They had historically been committed to the communistic way of life, but then there were a couple of things, which we'll talk about in a little bit, that caused them to realize they needed to change things. And as a result, they've achieved this magnificent growth over the last 40 years, using kind of an interesting blend between free market and state involvement. So all that to say, if we take a look at their historical GDP growth, on the left-hand side, you can see China has achieved 9.3% average GDP growth per year over the last 40 years. You compare that to the US over that exact same time period, and you can see that our growth of 2.6 has been significantly lower. That means that China has more than tripled the growth of the United States from a gross domestic product or output of their economy over the last 40 years. China's effectively doubled their economy every 8 years. And the World Bank described their growth as, and I'm quoting what they said here, the fastest sustained expansion by a major economy in history. As a result of this, we've seen China raise an estimated 800 million people out of poverty. They've become the world's largest manufacturer, merchandise trader, and interestingly, the largest holder of foreign exchange reserves. If we take a look at how they impact the United States, they're the US's biggest source of imports. They're our third largest export market behind Canada and Mexico. And they're also the largest foreign holder of US Treasury securities. which many people would say that puts us in a bit of a predicament. But all that to say, when we understand this growth that China's experienced, it really vaulted them into prominence on the world stage. So you can imagine that with this kind of as the backdrop, China is very important when it comes to the world, the global economy, and what's happening there is certainly relevant to everybody else in the rest of the world. Now, there's an interesting thing that's been happening. We've seen this exceptional growth primarily as a result of free trade and incorporating some free market policies. But if we take a look at just the last few years, China's economy has really matured significantly. And we've seen a real significant decline in their growth rate. If we look back to 2007, their GDP at that time was 14%. And if we look to just the year before the pandemic, which would have been 2019, their growth was 5.9. So we could see a significant decline already. And one of the reasons for that was China was recognizing their need to shift from really being reliant on foreign investments and exporting and really moving to more of kind of a consumer-based economy. And Josh will talk more about that in a little bit. But in addition to that, there's a real significant demographics problem that China is facing at this moment. I think we've all heard about that, but it really comes down to China's working age population. And it all ties back to the one-child policy that has been in place since, coincidentally, right at the same time that they initiated these free market reforms. They were seeing the need to, hey, we need to get growing here. We need to figure out a way to grow our economy. We have a growing population. We need to curb our population. We also need to improve our economy. So they instituted free market reforms, and then they also put in place this one-child policy. Well, that's beginning to catch up with them. If we take a look here on the left-hand side, you can see that back in 2011, their working age population, which would be people between the ages of 15 and 59, their working age population peaked at about 925 million people. Now that's, to put that in context, that's more than, that's about 3 times the size of the US population. It then subsequently has declined. We can see that in 2015, it was at 911 million. And just last year, the census came back at 894 million. Now at 894 million, that's not a significant decline, but the projection is that in 2050, there's going to be a population in that age range of 700 million. That is a potential loss of 225 million workers over that time period. And at the same time, all of those people that have been in that working age population are moving into retirement, which is going to put a significant burden on their economy. So what did China do? Well, they did what China always does and got the government involved in an attempt to counter what they put in place previously. So in 2015, they began easing up on those restrictions for the one-child policy. And they initially bumped it up to 2 children per family, and they've since bumped it up again to 3 children per family. Now, unfortunately for them, that has not led to the baby boom that they were anticipating. And one of the reasons for that is really couples have become accustomed to, you know, the smaller families or even the freedom that comes without having children. And the costs and the burden that comes with raising children was something that was on their minds as well. So this has driven, in part, one of the first areas that China has cracked down from a regulation standpoint, which is the education area. It's really driven China's emphasis on cracking down in that area. What their objective is, Beijing is seeking to really ease the burden and anxiety for Chinese parents as they think about giving their child a good education and raising them. Their ultimate objective is to encourage more population growth, hopefully lowering the cost of raising children and just relieving a lot of anxiety. So what has China done? What was their solution in this case to promoting population growth? And if we take a look at the education crackdown that they put in place, they kind of attacked two areas. The first was private tutoring. We think about here in the US, the value of a good education, and it's certainly highly valued, but in China, it is essentially the end all be all. So we have parents of these children investing a significant amount of their time, their hard-earned resources into making sure their children get the best education. Well, as it relates to tutoring here, Beijing really cracked down in two areas. First, they effectively told the entire tutoring business, whether it be online or in person, that you have to kind of re-register as a nonprofit. You've been operating as a for-profit business for so long, but now you need to operate as a not-for-profit. You can imagine that spooked a lot of investors and effectively made a large swath, about 90% of this tutoring industry. It made it effectively uninvestable. What they also did, and this really was probably one of the most damaging aspects about this tutoring industry, is they limited the tutoring hours to effectively only weekdays. So you couldn't tutor on the weekend or during holidays. And there was just a limited number of hours that they could do so. So what that did, and to give you some context here, the tutoring industry in China is about $120 billion industry. And with the exception of about 10% of the tutoring industry, which really focused more on sports and kind of extracurricular activities, it's at risk of almost being entirely wiped out, which is why we saw at this news, China's education industry subsector of their stock market dropped as much as 14% immediately after this news. It's since fallen significantly more. We've seen some stocks, TAL Education Group is actually listed here in the United States. It fell significantly. It's listed in the United States, but its focus, its area of service is almost entirely there in China, which is why we saw it. But we've seen those stocks fall about 60 to 80%. And that's led a lot of investors to say, well, if they've done this in the tutoring area, what are they going to do in the rest of the areas? And we'll get into more what that looks like. But they didn't stop with just tutoring. They actually expanded their regulations also to private schools. And interestingly, private schools are a big part of the education world there in China. They actually account for 1/3 of all of the schools in China, with over 186,000 private schools, and they account for 1/5 of all Chinese students. And the regulations that they've put in place there is they're wanting to ensure that those private schools are falling more in line with the national curriculums, effectively making them more like public schools. And they're also limiting their revenue streams and preventing foreign ownership and investment into those companies or into those schools, which obviously is going to really impact the profitability and the investability of those private schools as well. Now, all of this is being done, remember, with the backdrop of we're seeking to promote population growth, we're seeking to strengthen education, trying to level the playing field, reduce the burden, the stress, and the cost of raising children, hopefully making it more enticing for couples to have children. Now, that's only the beginning, and that's the real fear here, is they began with education, and maybe that was understood, but they've continued to crack down. And for that, I'll turn it over to Laura to continue the conversation. She's going to chat with us about the technology sector and a couple of other areas. Laura, take it away.
Thanks, Max. So as Max mentioned, for the past 40 years, China has operated under this semi-free market, semi-communistic economy, which has really allowed certain sectors like the tech sector to experience this period of extreme savage growth. And this is not just true in China. If we think about the certain sectors across the globe that have been really successful, especially here in the US, tech has really led the S&P 500, and it's led the world as far as returns over the past decade. And that has led to some really successful tech companies coming out of China, companies like Alibaba or Tencent, that have had really successful runs, on the global stage in the tech world. And that's also led to some really successful individuals, people like Jack Ma and others, who have founded those companies and seen extreme success and extreme wealth come out of those opportunities. as Max mentioned, not only is China really trying to refocus on creating equal opportunities for all citizens, they're also trying to refocus on creating equal opportunities for all companies as well. And that's led to a list of regulations that we've seen come out of China in the past 3 months, really, and every day, really cracking down on the tech sector. We start with algorithms. As most of us know, for tech, algorithms are really important for companies' abilities to be able to gather data from their consumers and use that data to then remarket back to their consumers, and also sell that data. You know, we've seen that happen with Facebook and a lot of other companies. That data is really important. And China has limited tech companies' abilities to be able to use that data to market certain products back to consumers, but they're also no longer allowed to sell that data to foreign investors. State-backed cloud systems with companies like Snow going public here in the US. This is one area of tech that is a really big focus of the future. By China creating their own state-backed cloud system, it prevents potentially a monopolistic company to come in and take control of that sector, but it also creates an area where all of the information held by China in that cloud-based system is now owned by the Chinese government, which we can all think about how scary that might be. Now, one of the biggest regulations that's surprised me over the past few months are the crackdowns that they're making amongst minors. And in China, if you are under the age of 18, you can no longer play video games during the week. You are limited to only being able to play video games on the weekends for 1 hour a day between Friday and Sunday. Thought of this happening when I was a kid is horrifying. I was a pretty big gamer when I was young, but just thinking about how this affects all of their citizens, that China is really convinced that there is a technology addiction problem amongst minors in China. And this is trying to help refocus their attention less from tech and more towards education, more towards becoming more productive members of society. They've also banned kids who are younger than 14 from being able to get on apps like TikTok to only 40 minutes a day. Again, trying to limit their exposure and also limit their time spent online. The last 2 points that I'll make, China's banning cryptocurrencies within China. So currencies like Bitcoin and Ethereum will not be allowed to be used in China. What they've actually done is created their own digital currency, their own digital payment system. And their hope is that that becomes the highly used and most commonly used currency. We think about one of the benefits of digital payments and blockchain technology. It allows us to be able to track different transactions being made across the internet and across the world. So the idea that China is creating their own digital payment system, you can kind of make your own assumptions from there on what they're going to do with it, but they are banning the use of Bitcoin and other cryptocurrencies from being used in China. The last thing that I'll mention is they've made a lot of crackdowns on current technology companies, and that's had a huge effect on the stock prices of companies like Alibaba and Tencent, companies that have had really great growth over the past 10 years or so. But they've also really started to put regulations on even new companies from coming to the market. Jack Ma, the founder of Alibaba, recently wanted to take another company of his public. It would have been the largest IPO in history. And the day before the company was set to IPO, the Chinese Communistic Party pulled the plug and did not allow them to go public. Same thing with a company called Didi, which is basically China's equivalent of Uber in China. They had been public for a week and China pulled them off the market, pulled all of their funding, no longer allowed to go public. So they're really focused on not creating opportunities for these tech companies to become large again. Now, if you've heard anything in the news about China in the past few weeks, you've probably heard about the situation with Evergrande. And this is a situation that is developing every hour on the hour. But just to start off with, sorry, I seem to lost my slide. Just to start off with where we are with Evergrande. Evergrande is a Chinese real estate development company, and they're pretty famous for being the largest indebted company in China. They owe about $300 billion to creditors. And they've recently just, have not been able to make their debt payments. And that's created this question of what's going to happen. Is Evergrande going to go bankrupt? And if that does happen, that $300 billion that they owe, how does that affect capital markets globally? This has been, when this first started happening, the question really became, is this an isolated problem, or is it going to affect the larger real estate development market? And one thing that's really important to note is that China changed the game on real estate development companies in the 11th hour. They decided that they would limit the amount of credit and the amount of debt that these companies could take on. If you think about a company like Evergrande, who's spent almost their entire history using significant amounts of debt to fund future projects, when your amount of debt that you can take on is limited, you're no longer able to fund future projects, which means that you're not able to take in those future revenue sales. And that affects your ability to pay your current debt. And it's a snowball effect that goes from there. We've seen companies like Evergrande, Modern Land, and Fantasia Holdings all miss debt payments in the past few weeks. And one of the biggest questions is this going to have a contagion effect, not only amongst the Chinese real estate development market, but also amongst global capital markets? One thing that's really important to note, Evergrande owes $300 billion. Some of the other smaller companies that are defaulting on their payments, companies like Modern Land, owe about 1.9 billion, and Fantasia Holdings owes about 19 billion. So significantly less than a company like Evergrande. But I think it's important to note this is that we're keeping an eye on. And we think that the contagion risk outside of China at this point is low, but it is important to note that under the current circumstances, that is something that we are watching. And with that, I will turn it over to Josh.
Thanks, Laura. Appreciate it. So one other thing just to note there with that last slide that Laura was looking at is that if you look at the top 30 or 40 major property developers, there's only about 4 of them that no longer have access to capital because they have breached the new lending standards that the Chinese government have allowed. And that's going to be a huge thing. And so because of that, we don't think that this is probably another Lehman Brothers kind of situation where most of the banks or most of the property developers in China are going to have larger systemic problems. So I want to take us, though, in our last 7 or 8 minutes here, talking about the bigger picture, because it's important to understand the motivations and really the narrative that's going on here. Everything we're seeing coming out of China today is not an accident. It is part of a bigger picture and part of a plan. And so the language that China is currently using is that of common prosperity, which is very simply the outworkings of the Chinese Communist Party's beliefs of redistribution of wealth. They have had really one major goal over the last 30 years, which was to grow, but it was to grow for a purpose. And that was to grow so that they could employ the vast number of people that were working in the interior of China for next to nothing, $2 a day in most cases. And so if you look historically over the last 30, 40 years, about 15 to 20 million people have been moving from Chinese interior to developed cities and looking for jobs because they've wanted better economic prosperity. But in order to do that, China had to have tremendous growth to support that. And so for the longest time, the Chinese Communist Party only cared about one thing, which was growth at all costs for the purpose of maximizing employment of all these people that were moving and trying to develop a middle-class lifestyle for themselves. That has changed. In the last 2 years, that has changed. So specifically, this chart really shows it. So if you go back to 1985, you'll look at the amount of people that China's working age population has been adding. And that number has ranged somewhere between 10 and 15 million on average. But what you'll notice as we start to get into the 2010 era and beyond is that we no longer add workers to that number. In fact, starting in 2011, we start to see small decreases. And what we see is in the future projections that the number starts to fall off the cliff the other direction, that China will actually be losing 5 to about 10 million people on average in that population. So China's concern today now is no longer employing its population. Its chief concern has now shifted. And for us as investors, it's important to understand what that shift is, because that probably will dictate what the next 10, 20, 30 years looks like for Chinese priorities, and also helps us to understand what is investable in China and what is not investable in China. So moving forward, China's journey is more focused on shifting from a very globally integrated economy to an economy that is not domestic, that is not dependent upon other economies. So for some context here, we've had a couple of very significant things that have happened. The first of which was under Trump, Trump going to war with Huawei, the Chinese tech company that was looking at 5G and everything else. You guys probably remember that. And Trump literally had this company completely at his mercy. Why? And that becomes down to this first major point, which is that China is dependent upon the West and other outside parties for its semiconductors. In a world where everything is electronic, semiconductors are the major building block that allows us things to move. It really was what energy was 30 years ago. China today, it's its largest import, $30 billion a month of semiconductors are imported to China. And that's really what put Huawei at Trump's mercy. Because at the end of the day, if Trump said, we will no longer allow anybody to import semiconductors to you guys, it was over. So basically Trump, in a proverbial sense, chopped off Huawei's head, and the Chinese literally could do nothing about it. It was a national embarrassment, and it was something that multiple Chinese party officials said they did not want to see ever happen again. And so, in fact, some would argue that's one of the big reasons that there's a huge tension in Taiwan right now, because Taiwan has one of the biggest semiconductor producers in the world. And so it's one of the things that makes Taiwan a very attractive acquisition for the Chinese government today. So that's the first thing. The second area of dependence is on foreign energy. China imports about a little bit shy of $400 billion of energy every year. And the problem is they can't source this themselves. Unlike the United States, which actually had the natural gas and the oil that we could source ourselves to be energy independent, China does not have that same capability. And so it's no coincidence that China has recently decided we are going to hit our peak green emission, our carbon emissions in 2030. And from that point forward, we're going to be pushing a very strong green initiative. I got news for you. It has nothing to do with the fact that China cares about being green. It has everything to do with the fact that China cares about not being dependent upon other countries for their energy. China, when it comes to this, is very dependent on inbound ocean ships with most of this energy. And as a result, any nation who can threaten to navally blockade them can stop them from receiving vast amounts of the energy that they need to produce things. You know, China is looking back at World War II when the exact same thing happened with Japan. It was one of the major problems in the midst of World War II, and they don't want the same thing to happen to them either. And of course, the last major component of dependence is on the US dollar. Today, the US dollar is the world's reserve currency. It is the predominant method of trade. The challenge, though, is the Chinese know that the United States can weaponize that. They've done it in the case of Iran. They've done it in the case of Sudan and Yemen. And it would be a very bad idea for the United States to do that. But the United States could theoretically choke the Chinese off from a supply of dollars and therefore limit their ability to be a world trade superpower if we ever came to a serious international incident. And so because of that, China has begun to really shift from let's employ everybody we can as quickly as we can to we want to become as nationally independent as we possibly can. And we're going to be instead focusing on the efficient use of capital. Before, when the goal was just employment, they didn't care if large real estate companies like Evergrande borrowed excessive amounts of money as long as they employed the workers that were coming in from the interior. Today, that is no longer the case, which is why they've had such a sudden shift in their policies surrounding how much debt different companies can access. So the real question is this: should we be concerned? And the answer is both yes and no, as most good questions in economics and investments are. If you were heavily invested in risk assets in China, you absolutely should be concerned. Because with China's shifting priorities, there's also a lot of shifting initiatives that are taking place. So, like, as an example, one other area that just literally came out in the last couple of hours is China is considering a new regulation which would ban all foreign investment from Chinese media and telecommunications that are public facing. They haven't actually decided they're going to do it, but that is a new regulation that they're floating out to the public to see what the reaction is. So there are probably over the next several years major industries that used to be allowed to have foreign investors that will not have foreign investors. And in fact, there's a decent chance they will have additional efforts like what they've done with the private tutoring, where they literally steal the investments that have been made there and say you're now a nonprofit and investors can't get their money out. So there is definitely risks in China that people need to be aware of. Now, we do think at this point with the data that we have that most of the risk will be localized to Chinese investments. And so far that's been the case. So the Chinese stock market's down 30 to 40% this year. So far, most of the rest of the emerging markets are still doing fairly well. The United States and Europe as well are right on track to have good, consistent growth. But the risk that you always run in a situation like this is contagion. If you have enough defaults, if you have enough investments that are lost, will it cause a trickle effect that can spill over into other economies? That is definitely a risk. At this point, we think it's a lower risk, but it's one we're definitely watching closely. And the biggest conclusion that we as an investment committee take away from this is that investors can't just own an index if you want to invest in emerging markets. China is illustrating the challenges of investing in an emerging market where a lot of countries have state-run enterprises. And the government literally has the ability at any point to come in and say, we're taking this over, and all the investors lose everything. That is a reality now that China is making it very difficult. The other side of things that's important to note, with China's new focus on more of a green energy initiative moving forward, that will absolutely lower the growth rates in China. Instead of seeing that 7-8% growth rate, a lot of economists have projected that we could see growth rates that drop to 4, 5, 6%, which would be big drops from what we've historically seen. And so this doesn't mean that we completely avoid China, but it means that we need to be much more careful about it, and we need to be working with groups that are very cognizant of the risks of particular industries as they look to make those investments. And with that, we will open it up for questions.
First question comes from Tim. He said, recently heard that inflation will rise faster than what the Fed is predicting for the fourth and into the first quarter. Is the Fox Alliance also predicting this to occur? Josh, would you take that one?
Sure. Real quick before we do that, just as a reminder, if you have any questions, feel free to send them to bill@thefoxalliance.com, and we will try to answer those as we can. Yes, so, and we've talked about inflation a lot in the last couple of quarterly economic outlooks. So the Fox Alliance's view on inflation is that short term, it is definitely going to be a problem. Longer term, we think it'll be a problem. The real question is whether in the medium term it'll be a problem. So for the next year or two, and to a large extent because of supply chain breakdowns, we think inflation will be a substantial issue. We'd also argue that the Chinese population and the decreasing working population is another contributor to that. For the longest time, there was a very large source of cheap labor in China that could be used to effectively import deflation into the United States. But as the Chinese population has become more middle class, and there's been a lower number of those groups that are still doing low cost labor, the ability to import as much deflation as we have in the past has become more scarce. And with supply chain breakdowns that have happened, we do think that inflation for the next year or two will be more severe. Now, moving beyond that, there are a lot of deflationary forces on the horizon. Whenever you have technological innovation, that's always a deflationary force. Also, debt. Debt is a deflationary force. When you have money that has to go towards interest payments as opposed to spending on new goods, that inherently takes away money that could cause inflation. And so we're less certain about what inflation looks like 3 years, 4 years, 5 years out. But in the next year or two, we do believe that inflation will be elevated, and predominantly because of supply chain issues that are taking a long time to be resolved.
Thank you, Josh. Next question. With Congress kicking the can down the road on the next debt ceiling, how does the effect of the stock market and how does that affect the stock market? And how should investors be concerned come December? Max, would you take that one?
You bet. So, well, essentially what happened here was there was a big concern related to the fact that the Treasury was getting kind of up against the maximum allowable amount that they could borrow. And if you know anything about how the government works effectively, very consistently, the Treasury is issuing new bonds, borrowing more, and using that to fund, generally speaking, past liabilities or expenditures that have been put in place by Congress. And interesting thing to note, we've actually raised the debt ceiling almost 100 times since World War II. This is something that's been in place for quite some time. And most often we don't hear anything about it because it's a rather non-dramatic situation in Congress. But in recent years, it's become much more partisan and really become kind of a tool that, depending on who's in power, the non-controlling party uses to apply some leverage. We actually saw this probably most significantly back in 2011. And at that time, there was a lot of debate, and this was really in the news, because with all of this kind of gridlock in Congress, it prompted Standard & Poor's to ultimately downgrade the US government's credit rating, which was the first time that it ever happened in history. I think that probably got the attention of Congress, and they subsequently agreed to raise what was then a $6 trillion debt limit. Just for context, we are almost 29 trillion. So we've almost doubled since just 2011 in the amount of debt that we have. But we saw another contentious debate in Congress back in 2013 when we saw the what at that time was the debate relating to the Affordable Care Act. And the right was trying to use that to use the debt ceiling to prevent the left from getting that passed. That subsequently led to Fitch, one of the ratings agencies, putting kind of the United States on a watch list. All that to say, if we were to get to a point where Congress does not increase the debt ceiling, and we get to a point where the US actually defaults on some of their loans or some of their bonds, that is a serious problem. There are going to be massive implications to that throughout the economy. And that's something that, in our opinion, is extremely unlikely. Because imagine if you are a congressman or woman, and you're in a position where you're accountable to your voters. You can essentially almost directly tie what would be the outworking of this to the votes that these people are making. So the likelihood of politicians wanting to put themselves in that position where they're unable to reach an agreement is extremely unlikely, and something that we don't think is going to happen in the future. Certainly could, and we of course are keeping an eye on those things. But I would expect that in every instance, even if it's a last minute type of thing, Congress is going to come to some agreement on that in the future, and we'll probably end up raising the debt ceiling another 100 times in the future.
Thank you, Max. Stuart asks, as China reduces imports for energy and other sectors you mentioned, will other nations retaliate to import less from China? Who would like to take that one?
I can take that one.
All right, Josh.
So in most cases, in the short term, what it looks like is China's already starting to try to build natural gas pipelines over land so that they will not be as susceptible to an embargo or some situation where they would be threatened at sea. And so there's already talks of a large natural gas pipeline being built along their coast. And so will that eventually it will affect the carbon energy markets. because eventually their goal is to ultimately replace it with more green favored sources of energy. So will it result in additional retaliation? I don't know if it'll do that so much as will it what it will ultimately do is it will change the buying patterns of one of the most significant countries in the world. We're talking roughly 10% of all energy consumption today is coming from China. So for people that are currently selling to them, that's who will probably have the most direct effect. But I don't see most of those players or countries aren't really in a position to retaliate with China to cause any kind of significant diplomatic issues.
Thanks, Josh. Next question. What are your thoughts on the current environment regarding interest rates and where they're headed? Laura, would you take that one?
Sure thing. So this is obviously a really important question. It affects a lot of our everyday decisions, how we buy homes, how we buy cars, and even how we buy investments. Excuse me. Of the 18 Fed policymakers, 9 of them are in agreements that interest rates need to go up sometime next year. And almost all of them, all but one, are in agreement that interest rates need to be at least 1 to 1.25% by the end of 2023. We agree that if there's a lot of things that are obviously going to go into play when it comes to interest rates. One is inflation. If inflation is less transitory than we expect it to be, or than even the Fed expects it to be, interest rates are one area that they can use to help combat inflation. And so if that does happen, that's something that we can expect to see the Fed do is really focus on raising interest rates, maybe even sooner than the target that they've outlined. The other thing is the Delta variant. The Delta variant has kind of put the economy back as far as growth. And that's made an argument to not have to raise interest rates as fast. If we have some sort of other variants, or if supply chain issues work themselves out faster than expected, then that might be an area where we see interest rates not go up as fast as they are expected to be. So our expectation is that, we've been in a period since 2018 of declining interest rates. Last year, interest rates hit an all-time low. Do we expect interest rates to go up? We do, especially as the economy continues to recover. But we've been in a period even pre-pandemic where interest rates needed to go up in some sense because they've just been at such lows over the past 3 to 5 years.
Well, that's all the time that we have for today. Thank you, Max, Laura, and Josh for your insight today. We're looking forward to seeing all of you next quarter, and thanks for listening today.